Let's bring back in our folks here to discuss what the kind of setup is here this morning. We've got Chris Versace of Tematica. We've got Meera Pandit of JP Morgan Asset Management. And Meera, it does feel like, Chris was earlier talking about all of the push and pull, and it's like one thing after the other that has been happening recently in the markets. But it also feels curiously sideways at the same time. Given that we are sort of in this event overload, if you will, what's going to be the thing that will be a catalyst to the up or downside in a more decisive fashion?
Well, let's consider what we think is priced in and what we don't think is priced in. So in terms of things that are priced in, it looks like based on both yields and the equity market, a Fed pause is priced in at this point. And what we saw last year was as expectations for the federal funds rate continued to rise, the stock market continued to fall, and of course, yields continued to rise. So now that we've seen a little bit more stability, it seems like that's reflected. But I think the reason we haven't seen a more pronounced leg down is the fact that it's hard to deny that economic data has still been pretty solid, mixed at worst. But for the most part, it's been fairly solid, and it's really hard to see earnings fall in the immediate term that much further when economic data is still strong, when the consumer is still strong. So while I think that weakening could come in due course, it hasn't happened yet. Therefore, stocks don't really have that downward catalyst to react to yet. But I don't think we're pricing in all of the different situations that might arise when we do potentially have a recession. So perhaps that is the next shoe to drop. But even if we look under the surface of the market, a lot is being driven by a couple of tech stocks. The rest of the market actually has been reasonably weak and hasn't really gained that much on the year. So a little bit in wait and see mode.
What does it say that the move, at least in the S&P 500 that we've seen to the upside, where we've still been basically going sideways to this point, and we've got just seconds to the bell, so maybe I'll save this question for the other side of the open, but just putting it on the table, we've been sideways, and throughout earnings season, we've stayed that way. We haven't seen an outsized move to the upside here.
3,800 to 4,200, back and forth.
Yeah, definitely a little like ping pong ball back and forth between those. There's the opening bell on Wall Street. Let's do a quick check of the markets as we get underway this morning, sponsored by Flex Shares. And we do have a little bit of upward movement here in the major averages, still waiting for the NASDAQ to open up since it's a bigger index than the others. It usually takes a little more time. But we are seeing a little bit of upward movement here, which is interesting given the trepidation that we saw reflected yesterday after Home Depot, and now coming with Target, but maybe Target's news sort of mitigated by, again, not changing that full year forecast. So all three major averages in the green, up about 0.4%. And we'll continue to watch the retailers very closely, not just Target today, but of course Walmart going to be coming out. It looks like Target is down a little bit here at the open. Has been sort of bouncing back and forth between gains and losses ever since those numbers came out.
Absolutely. We're also watching shares of Western Alliance this morning. They are rising after the bank said its deposits grew by $2 billion in the second quarter. Deposit levels at the regional banks have been under scrutiny after the collapse of several regional banks. Let's bring in Chris Versace and Meera Pandit back into the conversation here just to give a little bit more of the details on the deposits. They've said that deposits have stabilized. We're approximately $49.4 billion as of Tuesday, May 9th here. Quarter-to-date deposit growth of about $1.8 billion from $47.6 billion as of March 31st here. And so, all of that considered, we're really just looking for the deposit stabilization to perhaps signal the end of a flight of deposits or a flight of withdrawals, rather, from some of the regional banks here. We've continued to put the question out there, even to some of the senators, is the crisis over? And are the deposit and the withdrawal concerns done as well?
It's not over till it's over, Brad, right? I mean, I hate to say that, but that's the truth, right? So, there's always going to be a lot of ripple effects, and it's going to take time, right, to vet all of this out. But the more distance that we put, right, between Silicon Valley Bank, Signature Bank, and where we are, I think people can get a little more comfortable with it. Having said that, we've not even looked at any of the regional banks. We've actually preferred to play that flight to quality with larger banks, particularly Bank of America, because of the business mix that we like. Relative to that, and the shares have come down quite a bit, 37 to 27, 28, depending on where it is on the day. So, the bulge bracket banks will be capturing some of that outflow. They already have, and to the extent there is any incremental, they probably will.
So, sort of leaving aside the systemic and macro question for a moment, you're addressing whether you want to buy the banks right now. How are you guys thinking about financials?
We're thinking that, look, in a cyclical perspective, this is not the best time for financials in general, outside of some of the banking considerations. Yields are not necessarily going to move in banks' favor over time. So we want to be considerate of the fact that if we're thinking about recession oncoming, that we also have to think about some weaker profitability pictures for some of those financials. So we're a little bit more cautious there in the meantime until we start to see more of a turnaround there and some of this economic growth picture play out.